Screen. Huh,
No worries. We're all good to go.
there we go. Can you see my stream screen?
Yes, sir.
All right. Hey everyone, Michael here. Hope you guys are all having a great day today. Today we're going to be talking about bond rates because that seems like what the media has been talking about a lot of. Whether you guys have been watching CNBC, Bloomberg, Yahoo News, Fox Business, they've all been talking about these rates. But I want you guys to understand why they are so concerned about them and what it means for you guys going forward, because every time these rates tend to go up by quite a bit, you tend to have the stock market going down. Okay. So you see rates right now today. There are a few that I want you guys to pay attention to the most. These are going to be the 5-year rates and the 10-year rates. You can also look at the 20s, the 30s, the 2 and the 1 here. But for right now, usually I think 5-year and the 10-year are what I would recommend people look at. Okay. Now you'll notice that rates have been going up a lot over the past few hours. These are just hours charts. And what's been happening? The NASDAQ has been crashing back down. The SPY has been coming back down, and the Dow Jones has been coming back down. Now, they're all dealing with their individual technicals. Like you can see right here, the Dow Jones that has had a breakdown a few weeks ago, and it's still coming down, looking to test out a new level of support. You got the SPY right here, also broke down a while ago. Let me add that trend line up there for you guys. Right. And now it's coming back down to test out a support around that 50-week moving average. And of course, the NASDAQ, which is already broken down a while ago here, but it's been flagging. So people are just, waiting to see what happens next with it. Now, what's been the big concern with all of these rates is if you guys are looking to make money in the market, right? You usually have tons of different options, but the best place to put your money normally is just put it into stocks and watch the stocks go up over the year. Well, when you have these high yield bonds come onto the market because people are uncertain about how the economy is doing, what's going on in the world. Think of Russia, Ukraine, Israel, Gaza, what's happening in the Middle East with oil prices going up higher because they're cutting rates, all types of crazy stuff like that. People will look for other places to put their money that's nice and safe. And just like anything else, when everybody wants to buy something, the value goes up and people are willing to pay more. Okay. So there you see the rates going up higher and higher and higher. Now, in some historical context, when rates go high, people are pretty concerned about the economy and things like that. But when they start to come back down, that's usually because something very bad is happening. Okay. Now, there's a level of resistance up here that people have been talking about, especially on the 5-year. If you guys go to any of the major news and channels, and it's at 5% yield. We came closer to a few different times here, but we haven't actually broken out above it. We are very, very close. And the reason why this is so important is historically, again, if I zoom back out here, this level of resistance after this breakout, it's very close to what we had to deal with all the way back over here. And you see what happened back over here in 2006, 2007, that led to 2008. And that was a financial crisis of which, was very, very harmful to the economy and very, very traumatic for a lot of Americans out there who lost their jobs. So people are afraid that now that we're at these rates one more time, eventually when the rates do come back down, it's going to lead to a very, very bad economy going forward. But for the people that are buying these bonds, they're getting great deals. They get to park their money in here for a little bit of time, and then they're making a lot of money off of it. Or they can trade these bonds and buy right now, watch the value go up and sell them, and then short back down. All right, so let me move this around a little bit here. And the reason I kind of focus on this is because you got the 10-year right here, also looking at 2007 levels. That's not something you want to see. Going over here to the 20-year, definitely been going higher and higher and higher. Now, this one on this chart has only gone back to 2020. I wish I had a different one to pull up for you guys. But you see the one right here, 30-year, we're getting back up here to 2007 levels as well. So people are trying to, they're trying to compare basically how bad things were in 2007, 2008 to how bad they're going to get maybe in 2024. And of course, things have not been good in the American economy. If you guys have been anywhere close to here, you guys know how people have been struggling. Now, even though things are getting higher, it doesn't look like we've actually peaked yet. And that's probably because inflation has been going up. And on top of that, to be frank, we haven't had an opportunity to stop spending so much money. A couple of good things here, even though things have been kind of wonky across the economy, we still have a good job market. The economy has not gone into a recession. It's people feel like this is a calm before the storm, so to speak. So once these things start to tumble back down, that's when you know people are really scared about the direction the economy is going. Think of oil for a second here. Let me just pull up oil prices. Or better yet, let me just do it my way over here. There we go, U.S. oil. So this is a monthly chart for oil. Oil's been spiking up for a long time. It came back down towards the I guess when inflation in general started to come back down. Now, but once this inflation started to peak back up again, OPEC had their cuts. We did see a breakout right here, and now we're kind of retesting that. The only reason we've been coming down is because the economy is slowing, and people know the economy is slowing. Okay, that's a good thing for the Fed because they want recession talks to kind of go away a little bit. They also just want inflation to be coming down. But we're starting to see some of these longer term trends have golden crossovers, like the green line over the blue line. This is a 20 moving average. This is a 50. Those golden crosses usually move to larger moves, right? Green crosses the blue here. Green crosses the blue right here. See how it always goes up higher afterwards? So that's kind of the fear here that things are going to get much more expensive, which means inflation will go up, which means that interest rates would have to go up even more, which means that rates would have to peak up again, okay? And so when we're talking about these types of rates and, you know, these continue to go up, that means the overall market's going to continue to go down here. That's the big thing I want to convey to you guys right now. Today, I was pretty confident that today was not going to be a good day, but that's only because I was on Twitter and I was sitting down watching TV, and I noticed that, you know, I was watching earnings coming out. Basically, I don't have a life when it comes to investing, but look what happened. Alphabet had a horrible earnings. Texas Instruments had a horrible earnings. GM had a decent earnings. Microsoft had a good earnings. But because tech is so concerned right now, we're seeing a massive sell-off again with rates going higher and higher and higher. Really focus on this 5-year because that's what the media is going to be showing you guys a lot of. Once we broke out, it was a lot easier to continue to move up here. And so far, we're still getting closer and closer and closer to making higher and higher highs here. Let's go over to the daily chart. We're really close to breaking back out. And of course, right up here is going to be that 5% that we had talked about. If we break above 5%, you can imagine we're probably going to have another flush out moment when it comes to the economy. All right. Now, this is where pain comes in when you're talking about Jerome Powell and you're talking about what the Fed has been talking about. One of the things that I would always recommend that you guys do is go over and subscribe to the Federal Reserve's website. Let me show you guys this very fast. All right. You guys don't have to subscribe if you guys can always just type in Federal Reserve, but they will always have all of their major speeches and important meetings on here for you guys to watch. And you guys can have a little bit more of an understanding about what pain means. A lot of times when you see these press conferences right here or the open board meetings, these are usually going to be opportunities for you guys to hear what they what journalists are going to be asking them. Sometimes I like to go for some of these random meetings instead of some of the press conferences, because sometimes journalists, especially those at CNBC, Fox Business, they tend to ask questions more on a macro view and not so much of a micro view, like how is this going to affect me, right? So sometimes if you guys want to have a better understanding of what's going on, you guys may actually watch some of these other videos on here, okay? Now, pain basically means the Federal Reserve has made a choice here, and that choice is going to lead to a lot of different consequences, okay? So right now, we have a decent economy. You can see right here on the daily chart of the NASDAQ, the stock market's doing fine. People have jobs. People are making money. They can't spend that money as much as the money doesn't go as far as they want, but they're still able to actually, have a decent living here. In some circumstances, not even that. But let me just draw this for you here. There's a choice, okay? The first one here is I can move this down. There you go. All right, first thing is tackle inflation. I want to put this on top right here. So this is the goal, okay? The goal is to tackle inflation, but there's choices that are involved, okay? So the first one here is economy or inflation, all right? So they have different choices here, but their main goal, of course, overarching all of the policy at the Fed is going to be to tackle inflation. So that means if the economy starts to fall, right, and they have a decision to make about whether they want to lower rates in order to boost back up the economy, they have chosen that they're going to let the economy sink, and they're still going to make inflation their highest priority. If they have a choice, the economy can falter as long as inflation comes back down. And at this point, inflation has stopped coming back down over the past few months, ever since July, and all we've been doing is going sideways here. So if you guys go anywhere on CNBC or Fox Business, they're always going to be talking about these rates, and that's just because people are very concerned about what's going on. You can even see right here the 10-year that's up. People usually talk about it. S&P 500 falls to the lowest since June on disappointing Alphabet results, higher rates. All you have to do is go over here to Trading Economics, inflation chart. You can see I've clicked on this quite a bit of times. All right. Back in July, we started to go back up. All right. June was our best opportunity, up, up, up. And unfortunately, everything since then has been above that 3, which means now we're into the sticky territory. And remember, the goal is to get to 2%. And if we're not getting anywhere close to 2%, that means as the economy gets worse, the inflation is still the most important part. If inflation comes down, then the Fed can start working on bringing the economy back. But that's what the pain means. And at this point, economy is going down slowly. We can see this from the earnings, but inflation is not moving at all. We bumped up a little bit and kind of gone sideways. And that's not good, because the more this comes down, the more of a separation there is. And the Federal Reserve has stated multiple times through all of their meetings that this is what matters: inflation. Economy, yeah, it matters. But how can you have a nice economy if inflation goes rampant? Because if they lower rates too much to boost up the economy, all that does is make inflation go up, which means they have to raise rates again, which lowers the economy again, but the inflation will still be high. Think of what's happened in the 70s and 80s, which was definitely not a good time. But let's check out some of these charts here for today. That way you can just see that direct correlation. Definitely see how earnings were not too good. You had a pattern right here. We ended up breaking down below it, retested it. So if you guys wanted to enter back in, you guys could. But rates have definitely not been helping out with this today. And this is where the concern comes in. The economy's earnings over the last couple of days have shown the economy is not doing well. Now the Fed has to make a choice. And that choice so far has been, okay, well, we're not going to even think about lowering rates, not even maybe until 2025 here, which is a long ways away. So how much further will the economy go down before inflation manages to catch back up? That's going to be a good thing here going forward. All right. So check out this 5. Still moving up higher. Check out this 10, still moving up a little bit higher here. However, this is going to be the long game. When you start to get really afraid of what's going to happen to the overall market as far as, the recession talks and things like that, all of these bonds, let me go over here to the monthly charts. All of these are going to be coming back down. All right. Going up isn't the problem. Going up is just the warning that, something bad is happening, but it doesn't mean the thing that's bad that's happening is happening just yet. Okay. Remember, we had these 2 highs over here, right? That wasn't even a relative high, but we used to manage our finances a little bit better in the early 2000s, of course. But once over here, 2007, that's a June, we didn't see the worst, of the financial crisis and things like that until 2012, even though 2008 right here, when we had that first big crash, that was a 62% drop right there. That took 580 days. So don't feel like just because we're going up right now, it means that everything is over. As far as like the economy and stuff like that, we're still chugging along with the economy, but this is a big, huge flashing warning sign saying there's probably going to be a recession next year. Now, maybe the government can put more stimulus into the economy. That would make things a little bit more difficult, because that does mean inflation would probably go up, but people would still have jobs, even if they can't really afford too much stuff with the money they're making from said jobs. They might still be able to afford a place to live, but they might not be able to go out on a weekly basis to go grab, sushi or something like that, especially out here in Washington state. All right. So a few different things here I want you guys to focus on as well. There are some things that are not being affected by this at this point in time, and those type of things are going to be Bitcoin and cryptocurrencies. This has been a wild ride as far as news events. I was not expecting this at all. I had my scalar opportunities out here, and I had my first big scalar at this massive level of resistance. We broke through off of news. So this is just to show you guys that news is still going to be a good way for you guys to find some opportunities to trade. But if you guys are looking at the overall health of the market, these higher rates are not going to be a good thing. Certain things are affected by rates, and it seems like right now cryptocurrency is not thinking about them whatsoever. So if that's the case and you see oil rising today and things like that, just be careful that the more the world goes through these tumultuous times, especially when you think about the wars going on right now, you're going to see these rates get higher and higher. And this is a one-year government bond. It's not the most impressive thing. And you can see how wild this chart has been. But even here, we're still back at the levels we haven't seen since 2007. So just understand there is a big flashing warning sign. People are concerned, but they're hoping that the Federal Reserve can get the job done and that pain is not going to last for too much longer. Unfortunately, again, the longer inflation stays steady, the longer the, let me go over here. Let's get rid of all this stuff. The more the economy will start to shrink and come back down, which means, unfortunately, if you're investing in the market, you're probably going to be losing value. And if you feel like you're poorer because your 401k isn't going as far, along with higher inflation, mentally what that does to a society is that says, hey, I shouldn't be spending as much money. And that kind of is a self-fulfilling prophecy for how recessions start. People don't feel good. People feel like, uh-oh, I should stop spending. And as soon as you stop spending, right? This is you. As soon as you stop spending, all of a sudden, the guy that you'd be giving your money to, he no longer has any money. He's sad because he is now broke because you're holding your money over here and now he has nothing. And that means the economy, it stops working the way we need it to. So let me back up here very fast. Do one more little analogy for you guys. Remember, we're in a bit of a pickle. We all understand that. But the big picture here with pain, and I'm just going to say this one last time, and then the stream will be over, or this part of the stream will be over, excuse me, is that the more the economy goes down, the more everybody's going to be hurting. We all know that. But the Federal Reserve, their priority is not to keep the economy afloat at this point. It's just to tackle inflation. They are compromising by not raising rates up higher and higher and higher, even though they should. And that's okay because, we want people to have jobs. We want people to be able to, live right now, not to be homeless. But it's important that you guys understand that going forward, this will go down further and further. And the Federal Reserve is not going to be focused on this. There have been times in the past where the Federal Reserve has given up, right? So if I go back over here on the daily chart, or actually even the weekly chart, back in 2018, let me go to maybe the last 25 years. Let's see. What I'm looking for here specifically is going to be the rate. I'll pull this off to the side and show you guys this for a second. Well, basically, they tried to raise interest rates back in 2018. The market flipped out like crazy, and then they started to lower them back down, and they gave up on it. All right. This was fake pain. All right. The market played, a staring contest, and the Federal Reserve blinked first, and therefore the market kept on going back up. The Federal Reserve can't blink, and so we're going to continue to going down, and that's going to be the pain going forward. All right. So one other thing here, I can pull it up. I want to talk about the yield curves here. Oh, they might not have it on CNBC, which kind of sucks but that's okay. Let me see over here very fast. Let's go back over here to the 10 very fast. Go back over to the monthly here. So one of these things that I would recommend you guys look at every now and again, this is not usually used, but it's been working out okay for me so far, has been Fibonacci levels. You can see right now we're testing out a level of resistance here as far as what's happening with the 10-year rate. If we break out above that, it would normally suggest that we go up even higher, like way up here. I'm not going to open it up here because usually those things are pretty crazy, right? You have all these options up here. But one of those other levels is all the way up here towards 7.5%, 7.25%. I don't think we're heading there, but you guys can see that if things get much worse when it comes to inflation, let's say the Gaza war spreads out to the rest of the Middle East and we start bombing oil fields and stuff like that, that means less oil in the market, higher oil prices, higher inflation, more rates, things like that. Then you guys have to be prepared for a large spike that will come from that type of event, excuse me. And then on the way back down, you'll see the market really struggle as people really start to put into focus a recession incoming. One of the things that I think may work a little bit better here is if I just adjust this a little bit. There we go. Then you guys can see, let's go back a little bit further. That 6% right here, this is probably what I'm looking for. That goes back to 2000. We haven't been at those levels at a very long time. But here, when we were dealing with this type of pain, you have to go back in time and see what happened in the year 2000 with the stock market after having a rapid spike. Again, COVID kind of messed up everything we knew about bonds a while ago. However, what happened in 2000 was there was a big dot-com bubble. So you can see, again, 2000, you can see how big of a drop that had. 2008, how big of a drop that was. Hopefully, even with pain, any potential long-term move down might be something like a financial crisis. I don't think anybody wants to see this, and I don't think we'll see this. Hopefully not. A lot of stocks would have to crumble very, very fast, and you would have to see the whole e-commerce system really collapse on itself. Which could happen, but the likelihood of people still not spending money on Amazon, things like that, I think people will still spend what money they have because we're pretty much programmed to keep on spending, right? So one of the reasons why this is possible, though, and why people are kind of afraid, especially with the raising rates going up higher and higher and higher, is because of what I told you guys about the last time we were actually streaming together on TradeSing. And that's because the stock market can come down very fast. Right now, Google is down 10% on the day. Let's just go right here very fast. All right, gapping down, not a good look, not a good look at all. NVIDIA is down almost 4%. Microsoft is up, but they're still down compared to where they were at the open because the whole market is like, uh-oh. But hopefully, we have Meta earnings later on today. Maybe that'll help us out. But the whole market is just not in a good spot. We see Visa is okay and oil is okay. But oil is, if that follows the oil markets, MasterCard's down, MU's down, even Intel's down 5%. So tech is not doing well. But my main point here is if I just go over here to something like a Meta, all right, you see how fast this thing came down last year? It dropped down 16% right there. And let me go back over here to the weekly chart. That wasn't last year. That was earlier this year. This is what I meant to talk about. There you go. It dropped down 77%. All right. So you guys are going to have tons of opportunities to make money in this upcoming market, especially if there is pain, a lot of pain. This is kind of what pain looks like to a lot of tech companies. People seem to think that, oh, wow, yeah, we came down a lot, but we can't come down again. Oh, yeah, we can. This was only because of inflation. People were still spending money because of all the stimulus they had gotten at the beginning of 2020, right? And even 2021, after the Biden administration was put into place, they did one more aid package to everybody. I think everybody got another $1,600 check or something like that. So, we could always come back down here really fast. People will say, oh, we had support levels. Those support levels here, those support levels here, the support levels here. It doesn't matter when there's pain involved. So here we go. If Meta can drop 77% and a little over a year, I think it can still do that again. Even Microsoft is, I think, what most stocks would do. They would have a little bit more of a controlled move down, but it still dropped about 30%. NVIDIA still dropped around 70%. That is going to be the pain you guys are going to be feeling, okay? And to find some of those out, here are a few things that I'd recommend you guys look at. The first thing would be is that for all these different assets, you want to start to see these death crosses here, which means these green lines are crossing back down below the blue. Usually when that happens on a weekly chart here, the 50 crosses, the 20 crosses below the 50, usually that's not a good sign, right? Usually not a good sign. Over here, 2018, again, last time they rose rates, came back down here, and came back down here over the 200, and right there after reaching some nice highs. So play it safe. This is not really a good time to be buying in the overall market, I would say. But these rates have made it so complicated because normally, again, this is just NVIDIA here, but it applies to a lot of different stocks out there. As rates go up, the market goes down, or in NVIDIA's case, because they have AI, it actually goes sideways. Not everything has AI, and that's why you see stuff like, where's my favorite thing? You got Warner Brothers. That's where you get stuff like this, okay? You get stuff like Target. This is what pain looks like, all right? We've seen it plenty of times before. This is what pain looks like, unfortunately. But again, as rates go up, price of assets is normally going to go down. But the thing that kind of makes this so bad for all of us here is eventually, if rates go back down in a meaningful way, not just your normal up and down, right? If they come back down in a meaningful way, that means the overall economy is in such a bad state that nobody's going to be spending money. And then when they have their earnings reports, those earnings are going to push the price of the stock even further down. All right. So what we're hoping for overall is that the economy can somehow stay strong throughout all this. And if we have good earnings and a strong economy, only then, even with falling rates, can we actually go up. But we've had no semblance of the economy really getting like much stronger. All we're seeing down is the slowdowns because, of course, the Federal Reserve over the past few couple years now, they've been raising rates to try to slow down the economy to get inflation back down. That's really the crucial thing here. I wish I had better news as far as like what this pain entails, but it's just not going to be a good event. I mean, again, remember, Google going down 10% in a day, that doesn't happen, right? That rarely ever happens. Even over here, maybe that was a long candle bar. That was 2%. It was like 5% in 2 days. Normally, Google is not falling down that much. The last time it fell down that much, you could say was right here, perhaps. That's 7.5%. So they're not even there. You go back in time a little bit, and then we're talking about November of last year, and this was definitely not a good time. Here we go. This has to be close enough. Around 9%, close enough. We haven't seen this since the end of last year. So put all of that into context, everybody, and we're not looking at a very good economy going forward. The only thing that can save us, again, is if we have good earnings. And if I roll back around to my Twitter page right here, again, we're not seeing earnings being that good. The only ones that have managed to make some really good gains so far in this cycle have been Microsoft, and that's because they have AI. Google has AI. They have their BART thing that they've been trying to work on. Hey, it's not making them money. And if it's not making them money, it's not going to show up in the earnings reports in a positive way. It's going to show up as more of an investment instead of an investment that's paying dividends after all the work you've been doing. Texas Instruments, that one was down 4%. So we're not looking at a very good forecast going forward, because to kind of bring this all around now, because rates have been getting higher and higher and higher, the 5-year and the 10-year, and we've been watching them break out and have these really large moves. There's nothing the Fed can do about it because they want inflation to come down. And if this pain means that people stop spending money and inflation can come down that way, that's what they're willing to do. Now, there are going to be caveats here, of course, because the Federal Reserve cannot fix everything by itself. We all know that, I think actually I even saw it just a few seconds ago on CNBC's website when you started the stream. There was some breaking news. Yeah, here he goes. Mike Johnson elected House Speaker, putting Louisiana Republican in the spotlight. I don't know who this guy is. He seems like he must be liked if he managed to finally get the votes scrounged up. But this guy and the Senate and Joe Biden are all going to get together, and they're all going to try to figure out how to pass a budget. That budget is most likely just going to be a large omnibus bill at this point because of how long it took them to get their votes. That means we're probably going to be spending a lot more than we're taking in. That in and of itself adds to our deficit, adds to our debt. And that's going to mean that, unfortunately, that there's going to be more money in the economy. That money sloshing around is going to lead to higher inflation. Now, it's probably not going to show up as inflation going up, skyrocketing. It's most likely just going to mean that, hey, there's like a bottom to what we see with inflation, and it's going to get sticky for a while. And the only thing that makes us punch through that 3% barrier that we're looking at right now is going to be that slowing down of the economy, which should coincide with this coming back down as well. Okay, so hope you guys all enjoyed this stream. Be careful. Watch. The pain has just started. It's not going to be a straight shot down with any stock out there, but I want you guys to understand that it's not impossible for us to have these massive drops and crashes like we saw last year. It's just going to come from a different reason. It's going to come because people are seeing the slowing down of the economy, higher rates, and then inflation that's not coming down at a proper time. And when push comes to shove, when the Federal Reserve has to choose between the economy and keeping inflation down, they're going to choose to focus on inflation in order to keep everything as stable as possible. And they'll say, hey, we can weather an inflation, but we do not want to see hyperinflation because things will really get out of control there. And then once that starts, of course, the government has to keep on printing more and more money to try to fix the situation. That never ends well. It usually ends with like a crash of the financial system. And then from there, a slow, long recovery that usually takes about a decade. And that can lead to a lot of unhealthy effects for a country in general. And that's when you start thinking, can I even afford to live in America? Because now, think of rents at $2,000 on average, like, where I live in Tacoma, that may go up to $2,500 to $3,000 because the value of my dollar is gone a lot lower. And on top of that, the economy's gotten a lot worse. So, you might not have a job and then you can't afford an apartment. And then you got mass homelessness and you start getting into depression type talks, which is unfortunate. But that's if things get really out of hand really, really quickly. And at this point, it seems like we've been going down sideways slowly. And even if people lose their jobs, hopefully they have some type of system backed up to really help them get through the next few months. Okay. So thank you guys so much for watching. I hope you guys all have a great rest of your day.